Did you know that by May 2026, the Federal Reserve might be closer to cutting rates than many people realize? The market is waiting, but the Fed is walking a tightrope. In this video, you'll learn precisely when those crucial rate cuts are likely to happen and how to position your investments across stocks, bonds, savings, and real estate to benefit. If you find this breakdown helpful, consider subscribing. We simplify complex finance topics like this every week. And drop a comment below with your biggest question about the Fed's next move. All right, let's dive into why this matters so much for your money. Every single asset class you own, from your stocks to your savings account, is influenced by interest rate changes. Right now, the Fed funds rate is hovering between 3.5% and 3.75%. We're seeing core inflation at 2.8%, and unemployment has edged up to 4.4%. This data is why the Fed has hit the pause button. They're not ready to pivot to cutting rates just yet. They've repeatedly said they are data-dependent, meaning they'll watch the numbers, not just guess. The FOMC's dot plot shows they expect 2 to 4 cuts in 2026, but the timing is the big question mark we're here to answer. The Federal Reserve navigates a complex economic landscape in 2026. On one side, persistent core personal consumption expenditures, PCE, inflation lingers around 2.8%, a concern for the Fed's more hawkish members. Counterbalancing this, the labor market shows signs of cooling, with unemployment ticking up to 4.4%. This dynamic has led the Federal Open Market Committee, or FOMC, to pause interest rate hikes, but a pivot towards cuts remains uncertain. The FOMC's dot plot, a projection of individual members' preferred interest rate levels, currently indicates a range of 2 to 4 rate cuts for 2026. However, the precise timing of these cuts is the critical question. What does data-dependent truly mean in this context? It signifies that the Fed's decisions will be guided by incoming economic indicators, rather than a predetermined schedule. Consider the dot plot itself. It's a snapshot of the FOMC's collective thinking, offering insight into potential future policy paths. Imagine it as a weather forecast for interest rates. It provides an outlook, but the actual conditions can change. This forward-looking information is crucial for understanding the Fed's current intentions and how they might react to evolving economic data. The base case for the first cut currently points to Q3 2026, with September being the most probable month for the initial reduction. Historically, the Federal Reserve doesn't pivot to rate cuts impulsively. Instead, 3 distinct economic signals typically appear before the first move. First, there's a sustained increase in initial jobless claims, trending upward for at least 6 consecutive weeks. This indicates a genuine cooling in the labor market, beyond temporary fluctuations. Secondly, core personal consumption expenditures, or PCE, inflation needs to show a consistent downward trend, remaining below the Federal Reserve's 2.5% target for 2 consecutive reporting periods. This demonstrates that inflationary pressures are truly abating, not just pausing. Finally, a clear shift in the FOMC's forward guidance is crucial. This means the Federal Open Market Committee's public statements and economic projections must signal an intention to ease policy rather than maintain current restrictive levels. As of May 2026, let's assess where these signals stand. While unemployment has edged up to 4.4%, initial jobless claims have not yet met the 6-week sustained rise criteria. Core PCE inflation, though showing signs of moderation, remains stubbornly above 2.5%. The FOMC's recent statements have also been cautious, emphasizing data dependence rather than explicitly signaling an impending pivot. This cautious stance is understandable, given the delicate balance between inflation and employment. Considering these historical precedents, the base case scenario for the first Fed rate cut in 2026 points toward September. However, the possibility of an earlier, emergency cut cannot be entirely dismissed, particularly if labor market deterioration accelerates unexpectedly. The Federal Reserve finds itself navigating a complex economic landscape in 2026. On one side, hawks point to persistent core PCE inflation holding steady at 2.8%. Conversely, doves highlight a labor market showing signs of cooling, with unemployment gradually rising to 4.4%. The FOMC's own projections, the dot plot, currently signal 2 to 4 rate cuts for the year, but the critical question remains, when will these cuts actually begin? This segment aims to clarify two key aspects: the likely timing of these rate reductions, with a base case pointing to Q3 2026 and September as the most probable month for the first cut, and then, importantly, how to strategically position an investment portfolio across various asset classes in anticipation of these changes. Understanding the Federal Reserve's current stance is crucial. The benchmark federal funds rate sits between 3.5% and 3.75%, while core PCE inflation is at 2.8%, and the unemployment rate has reached 4.4%. The Fed has paused its tightening cycle, but a definitive pivot to easing has not yet occurred. The term data-dependent simply means policy decisions will hinge on incoming economic indicators. The FOMC's dot plot provides a snapshot of individual policymakers' expectations for future interest rates, offering insight into potential policy paths. Historically, three key signals have often preceded the Federal Reserve's initial rate cut. These include a sustained upward trend in unemployment claims for at least 6 weeks, core PCE inflation falling below 2.5% for 2 consecutive reporting periods, and a clear shift in forward guidance within the FOMC statement. As of May 2026, these indicators are being closely monitored. The base case scenario anticipates the first rate cut occurring in September 2026. However, a less probable but significant tail risk involves an emergency cut triggered by an abrupt shock to the labor market. What could such a shock look like? Consider a sudden surge in layoffs across major industries, leading to a rapid increase in unemployment claims that forces the Fed's hand. Understanding bond math is fundamental to navigating a changing interest rate environment. At its core, there's an inverse relationship between bond yields and bond prices. When interest rates, or yields, fall, the prices of existing bonds tend to rise. Consider a bond issued today with a fixed coupon rate. If market interest rates drop after that bond is issued, newly issued bonds will offer a lower coupon. This makes the older bond, with its higher fixed coupon, more attractive to investors. To purchase this more desirable bond, investors will bid up its price. This concept is often illustrated through duration, which measures a bond's sensitivity to interest rate changes. A bond with a longer duration will experience a larger price change for a given shift in yields. For instance, if the Federal Reserve were to cut rates, a bond with a longer maturity, like a 20-year Treasury bond, would likely see its price increase more significantly than a shorter-term bond. Historical data from the 2008 cutting cycle shows that long-term bonds returned over 25%, demonstrating the powerful impact of duration. So why does this matter now? As the Federal Reserve contemplates rate cuts, understanding this dynamic allows for strategic positioning. By extending duration in a bond portfolio, investors can lock in current yields, which are still relatively attractive, before they compress. This proactive approach can capture potential price appreciation as yields decline. When considering bond strategy amidst potential Federal Reserve rate cuts, a look back at historical cycles offers valuable insights. During the 2008 cutting cycle, for instance, long-term bonds experienced significant appreciation, with returns exceeding 25%. This historical performance highlights the potential upside for bonds when yields begin to decline. So what specific bond plays warrant attention now? Examining instruments like the iShares 20-year Treasury Bond ETF TLT and the iShares 7 to 10-year Treasury Bond ETF IEF can be instructive. TLT, representing longer-dated treasuries, historically performs well in a falling rate environment. IEF, on the other hand, offers exposure to intermediate-term bonds. Additionally, the iShares iBoxx Dollar Investment Grade Corporate Bond ETFLQD provides exposure to corporate debt, which can also react to shifting interest rate landscapes. Given this context, a prudent action plan involves extending bond duration. The recommendation is to move towards a duration of 7 to 10 years. This strategic shift aims to lock in current yields, which are generally attractive, before they are compressed by anticipated rate cuts. For example, current yields on 7 to 10-year treasuries are hovering around 4.5%, a level that may not persist once the Fed begins its easing cycle. When the Federal Reserve begins to cut interest rates, certain sectors of the stock market tend to perform better than others. Historically, during these cutting cycles, sectors like utilities, real estate investment trusts, REITs, small capitalization stocks, and growth-oriented technology companies have shown resilience and even outperformance. This is largely due to a phenomenon called multiple expansion. As interest rates fall, the discount rate applied to future earnings decreases, making those future earnings more valuable in today's terms. For instance, data from J.P. Morgan's Guide to the Markets, Q2 2026, indicates that during the 2001 rate-cutting cycle, utilities and REITs saw significant gains. Conversely, some sectors face headwinds when rates decline. Banks, for example, often see their net interest margins compress. This is because the spread between what they earn on loans and what they pay on deposits can shrink when short-term rates fall more rapidly than longer-term rates. Consider the 2008 cutting cycle. Many financial institutions experienced a decline in profitability linked to shifting interest rate environments. Isn't it interesting how the same economic shift can create winners and losers across different industries? This sector rotation is a key consideration for any investment strategy anticipating rate cuts. Understanding these historical patterns, such as the double-digit percentage returns seen in sectors like technology during the 1995 cutting cycle, can help inform portfolio adjustments. The goal is to align holdings with the anticipated market response, benefiting from the areas poised for growth while mitigating risks in those likely to face pressure. When interest rates fall, certain sectors of the stock market historically outperform. Analyzing past Federal Reserve cutting cycles, such as those in 1995, 2001, 2008, and 2019, reveals a consistent pattern. For instance, during the 2008 cycle, long-term bonds saw returns exceeding 25%. This phenomenon is driven by the decrease in discount rates, which makes future earnings more valuable, particularly for growth-oriented companies. However, not all sectors benefit equally. Financial institutions, like banks, often experience compressed net interest margins as rates decline, impacting their profitability. Considering this historical data, a strategic tilt within an investment portfolio can be beneficial. Adding approximately 5 to 10% to defensive growth and rate-sensitive sectors is recommended. These sectors tend to be more resilient and can capture upside as the economic environment shifts. Defensive growth sectors, for example, combine the stability of mature companies with the potential for future expansion, making them attractive when the market is uncertain. Rate-sensitive sectors, such as utilities and real estate investment trusts, REITs, often perform well because their established dividend yields become more appealing relative to falling bond yields. This strategic allocation aims to capture the broad market's repricing while mitigating potential downsides. The connection between mortgage rates and long-term Treasury yields is a fundamental aspect of the housing market. Specifically, 30-year fixed mortgage rates tend to move in tandem with the 10-year Treasury yield, typically maintaining a spread of around 150 basis points. Consider today's environment. The 10-year Treasury yield stands at approximately 4.4%, leading to an average 30-year mortgage rate of about 6.8%. Now let's look ahead. If the Federal Reserve's anticipated rate cuts successfully push the 10-year Treasury yield down to a projected 3.7%, what does that imply for mortgage rates? Based on that historical 150 basis point spread, this downward shift in the 10-year Treasury could translate to 30-year mortgage rates falling to around 5.2%. This is a significant drop, and it presents a clear opportunity for homeowners. For instance, on a $400,000 loan, a 1.6 percentage point reduction in the interest rate could mean monthly savings of approximately $400. To capitalize on this potential refinance window, it's wise to have the necessary paperwork prepared. This proactive step ensures readiness to act swiftly, potentially within 30 days of the first Fed rate cut, to secure a lower rate. Real estate investment trusts, or REITs, like VNQ, also offer a way to participate in the real estate cycle without directly owning property. When considering a mortgage refinance, the potential for monthly savings can be significant. For instance, a 1.6 percentage point drop in interest rates, moving from a 6.8% mortgage rate to approximately 5.2%, could translate to substantial savings. On a $400,000 loan, this reduction could mean saving around $400 each month. But what if direct property ownership isn't the most appealing route to capitalize on real estate cycles? Real estate investment trusts, or REITs, offer an alternative. An ETF like VNQ, for example, allows participation in the real estate market without the complexities of managing physical properties. Historically, the first rate cut in a cycle often triggers a rally in bonds, with prices rising as yields fall. Consider the 2008 cutting cycle. Long-term Treasury bonds saw returns exceeding 25%. This demonstrates the power of duration. For those holding bonds, extending duration to the 7 to 10-year range now, while yields are still above 4.5%, can lock in attractive returns before they compress. Similarly, the stock market often experiences sector rotation during a cutting cycle. Historically, defensive sectors like utilities, as seen with the XLU ETF, alongside REITs, small-cap stocks IWM, and growth technology QQQ, tend to perform well. This is due to multiple expansion as discount rates decrease. Conversely, bank stocks, like those in the KBE ETF, may see their net interest margins compressed. A strategic tilt of 5 to 10% towards defensive growth and rate-sensitive sectors can be beneficial. To be ready to act when the opportunity arises, it's prudent to prepare necessary paperwork for a mortgage refinance now. Being positioned to move within 30 days of the first rate cut could capture favorable terms before they disappear.